Hello traders, welcome back. Today is the 26th of January. My name is Devil Hornsey, market and trading, and today I'll be looking at why I want to sell the rips. Okay, today is FOMC day. Today, London session has started with a green bottom left-hand corner is Forex heat map, which to me is risk on, as we see that the top right-hand corner is red. So there's flows going into the commodity pairs. That means the London session, we're looking to buy into things like equities and these currencies. If we go to the active trader platform, we can see that the ES in the overnight session currently is showing a bullish nature. We haven't taken out the swing high yet from the 24th of January, and we'll look into that in a little bit sort of finer detail soon. We have broken market structure to the downside. We can see that we took out the swing low from the 18th of July 2021. So we took out 4231. When we were bullish, we were looking to buy the dips. So every time we got down to the 50 EMA, then we would look to see if the bulls would step in, and they did on several occasions. Obviously, some bulls would have left their stops down here, and they just got stopped out. But before that, there was actually a bit of a change in trend for a period of time here. So when it reversed back to being bullish, this was swing high here was taken out. So mid-October took out this swing high here. The bulls would have left their stops under this one. So both these trend followers here that have been in for a while and these sort of nearer term trend followers are both being stopped out now. So the buyers stops down here. Lack of selling, saw this big rip higher back up to the 200 EMA. This to me, this big move down, first three waves of a five-wave move. So we've got a first wave down, then a retracement, a longer wave down here. So we've got 1, 2, 3 waves completed. Now we're looking for a fourth wave to correct before a fifth wave comes back down. So that's Elliott wave impulsive move. This impulsive move is generally the bulls that have been long for quite a period of time now, taking profits, and then a little bit of overextension. What we want to see now is prices rise, so the rip higher, and then for the sellers, the sort of shorters of this market to step in, who believe that we're going to have a larger correction. So as prices rip higher, we're going to look for a test of liquidity. So where we had a daily low and then another daily low come in, when it retraces back inside those previous ranges, if it doesn't complete all the way up to the sort of day -2 low, then there's a gap which hasn't been tested. I've marked that up with these purple boxes and red box. We've also got the Fibonacci retracements, so around 4,520, also like halfway back of this downfall. If we go to the 61.8, then we're testing the sort of swing low from 10th of January, and the 20 and 50 daily EMAs that are dipping down now. And if we get a really deep retracement back up to 4,680 to 4,700, there's another liquidity gap there, which sellers could use should buyers think we're going to go for all-time highs. So the idea is that you look for those areas to get tested, and then for a reversal. Obviously, to get up there, we need to sort of see a bullish move today. So I've said London session starting more bullish, more risk on. If we take out this swing high here from 24th of January, then all of this down move here would be mitigated. That then gives us a bit of space to get up to this liquidity gap here, and then that's how we start to look for selling the rips. So I'm not going to be looking to buy breakouts. I'm going to look to see if we find resistance up at these sort of big levels, especially the 4,500 to 4,520. So that's what that will look like. The reason why fundamentally I think this is going to be lower for longer. If we look to the GDP growth in the US, yes, they had a big rebound after the pandemic lockdowns. We saw here 33.8% on the GDP. It's obviously come back down to more regular sort of percentages, even though these were quite high compared to historical GDP percentages. Now 2.3, starting to get back into the world that we sort of recognize. But the GDP now forecast from the Atlanta Fed shows that GDP should be coming down lower still. Obviously, the Fed have been trying to stimulate the economy. They have added to their balance sheets. They have kept rates low, and that's all going to be changing. So, the economy might be coming into some sort of stagnation. Further evidence of that stagnation could be seen in these charts that I've sort of built. Here we've got the general account from the Treasury. And yes, Janet Yellen was successful in removing the stimulus that was put into it by the previous US Secretary. But yeah, she's reduced that now, and we're seeing that actually building up. So the reason for that, I think, is because the US government are now running a monthly surplus. Normally they run a deficit. They're balancing the books by the looks of it. We're seeing more being taxed out of the economy than they are putting in. If we look to the fiscal flows left here, this is the 10-day moving average of the flows. Obviously, this was the rate at the beginning of the fiscal year. We had an uptick into the beginning of November, into like mid-November. Then as we approached December, we saw that the fiscal flow started to come back down and are now well below how they started at the start of the fiscal year. So that there's less money being pumped into the economy as such on a daily basis. But we are seeing here the 20-day moving average in taxes collected. We can see they started off here at the beginning of the fiscal year, and today's rates are elevated. We did spike up into the end of December. Look to the right, fiscal flows from the government, might have been reducing, but we were actually seeing a increase in bank credit to commercial and industrial clients. So people were using the bank credit, obviously, to buy inventory that was now available after some of the disruptions from the pandemic were reduced. So the most recent readings I've got here are showing that the bank credit is starting to sort of dip down. Yes, it can happen. We have like a bit of a pullback. As long as it doesn't sort of start diminishing, going back below these sort of levels, and I'm hoping that bank credit will sort of support the economy. But if we do get a reduction, this S&P 500 decline could be deeper. So going to an example of what I mean by selling a rip. I'd marked out on the dollar CAD that I've been looking for this old support to act as resistance when we tested it. That didn't happen. Prices just blew through that as the dollar increased in price. However, going back to that liquidity sort of gap, here you can see on the 6th of January, 7th of January, we had these equal lows. Then we had a big move down, all the way down to the lows here to test this swing low, took liquidity there. So on the way back up, after testing this swing low here, taking the liquidity there, we saw that they didn't quite make it to the previous low from the 6th of January when the 10th of January high was testing those levels, didn't quite make it up there. So there's a bit of a gap, which was again tested when they did finally get back up on the 24th of January. So now they've got some of that liquidity. This support here is now acting as resistance. We see here that today took out the swing low from yesterday, and now I'll be looking to see if we can take out the previous day and then this double bottom down here around the 1.244. So when you sort of have bearish market structure forming, when we get these rips, you look for areas where they could find liquidity to the downside. They find it around sort of big numbers like 1.27 on the USDCAD, and now we're looking to take these stops down here at these sort of wicks. So that's the idea of selling a rip. I hope that makes sense of why I'm looking to do that across the US equities at the moment. And if I find any more, I'll post them on the YouTrading.com website. All right, take care, and I'll speak to you later.